Government grants can be a lifesaver for businesses, but they can also be a headache if you don't know how to account for them. Should you recognize them immediately, spread them out over time, and how do IFRS and ASPE treat them differently? In today's video, we'll break down everything you need to know about government grants, IFRS IAS 20 versus ASPE 3800, with examples, journal entries, and clear exam-ready tips. Before we dive in, don't forget to like this video, subscribe to Canada Accounting Insights, and hit the bell icon so you don't miss future tutorials that make CPA content simple and practical. Let's start with the basics. A government grant is assistance given by a government to an entity, usually in the form of money or forgiveness of debt. In return, the entity must meet certain conditions, either past or future actions. There are two main types: grants related to income, help cover expenses like salaries or operating costs. Grants related to assets, help cover the cost of buying assets like equipment or buildings. Quick examples: a company gets $50,000 from the government to pay staff wages. That's a grant related to income. Another company gets $10,000 to buy a delivery truck. That's a grant related to assets. Now that we know what they are, let's move on to how we actually recognize and measure these grants. Under IAS 20, government grants are recognized when two conditions are reasonably assured. 1. The entity will comply with the grant conditions. 2. The entity will actually receive the grant. So if you have the money but you're not sure you'll meet the conditions, record it as a liability. Deferred government grant. If you've met the conditions but haven't received the money yet, record it as a receivable. For example, a charity is approved for a $300,000 grant to cover operating costs. They receive 70% upfront, with the balance payable once audited financials are submitted. If the charity is confident it can provide those statements, the full $300,000 can be recognized as grant revenue in the current year. Grants are initially measured at fair value, usually the cash received. For non-monetary grants like land or equipment, IFRS gives the option to record at fair value or a nominal amount. Now let's split this into the two key types: income-related and asset-related. These are designed to cover expenses. The golden rule: recognize the grant as income when the related expense is incurred. For example, a charity receives $40,000 from United Way to pay for operating costs. Expenses for the year total $120,000, so the full grant is recognized immediately. Journal entry: debit, cash $40,000, credit, grant revenue $40,000. This is called the gross method, showing it as separate income. Alternatively, under the net method, you reduce the related expense instead. Either way, the impact on net income is the same. Now, what if the grant is tied to an asset? That's where things look different. These help purchase long-term assets like buildings or equipment. Here, revenue is matched with expenses. The grant is recognized systematically, usually in line with the asset's depreciation. Example 1. An entity gets a $100,000 grant for lab equipment costing $250,000 with a 10-year life. Each year, depreciation equals $25,000. Grant revenue recognized equals $10,000 per year. So, over 10 years, the grant is fully amortized into income. Example 2. Franz Bikes. Franz Bikes receives $2,000 to buy an e-bike charger with a 5-year life. The grant is recorded as a deferred liability, and every year, $400 is recognized as grant revenue to match depreciation. Presentation here also matters. We'll get to gross versus net presentation shortly. But first, let's look at loans. Some government assistance comes in the form of loans, and these can also qualify as grants. If a loan is forgivable, it's treated as a grant once there's reasonable assurance the conditions will be met. If it's a favorable interest loan, for example interest-free, the benefit, the difference between fair value and proceeds, is treated as a grant. For example, an entity gets a $60,000 3-year interest-free loan during a pandemic. At market rate, 8%, its fair value is only $47,630. The $12,370 difference is recorded as grant revenue. If part of the loan is forgivable, say 1/3 if repaid within 2 years, then once those conditions are met, that portion is also recognized as a grant. Okay, so far we've looked at income, assets, and loans, but grants can also be non-monetary. Governments may sometimes give land, equipment, or other resources. Under IFRS, entities can record these at fair value or nominal amount. Example, George's Kids, a not-for-profit, receives 2 pianos valued at $6,000. They can either record them at fair value, $6,000 plus shipping, or at a nominal value like shipping costs $1,000. Under ASPE, however, this choice disappears. You must record at fair value. Speaking of ASPE, let's move on to the key differences. This is where examiners love to test you. Key differences. Non-monetary grants, IFRS, fair value or nominal. ASPE, fair value only. Repayable grants, IFRS, requires a cumulative adjustment for additional depreciation. ASPE only adjusts prospectively, no retroactive depreciation changes. Example, an entity receives lab equipment worth $125,000 with $10,000 installation costs. IFRS can choose fair value $125,000 or nominal. ASP must record at fair value plus installation equals $135,000. All right, let's wrap this up by looking at presentation and disclosure. Grants related to income can be shown in two ways: gross method as separate other income, net method offsetting the related expense. Grants related to assets can also be shown in two ways: gross method as deferred income, released to match depreciation. Net method, deducted from the asset's carrying amount. Disclosure requirements under IAS 20. Method of presentation, nature and extent of amounts recognized, unfulfilled conditions or contingencies. So the standard is clear. Be transparent about how much help you got, how you accounted for it, and whether you still need to meet conditions. And that's a wrap on government grants under IFRS and ASPE. We covered what grants are, when to recognize them, how to treat income versus asset grants, the special rules for loans and non-monetary assistance, and of course the key IFRS versus ASPE differences. If you found this breakdown helpful, drop a like, subscribe to Canada Accounting Insights, and share this video with other CPA students or business owners who need clarity on grants. And remember, accounting doesn't have to be overwhelming. With the right approach, it's all about connecting the dots. Thanks for watching, and I'll see you in the next video.